We have reached agreement to extend the debt ceiling through early December.
The pathway our Democratic colleagues have accepted will spare the American people any near-term crisis.
Some of this is a bigger picture, longer-term issue that's going to take years and years to address.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Default averted for now. The U.S. Senate passes a short-term debt ceiling increase until December. Investors look ahead to the U.S. jobs data later. China back in play while returning to the market after a week-long holiday. Services data actually beat and stocks rise. The PBOC drains cash from the banking system. And Tesla moves to Texas. Elon Musk tells investors a shortage of chips are the company's top threats. So first thing is first, a lot of news that we need to look out for, but actually the market kind of taking it in their stride. Now we're seeing a little bit of a mixed picture overall, a little bit of pressure on the stocks Europe 600. Again, what will give an impetus to the market or not is definitely that U.S. jobs report. It's the last piece of data that Fed members get before that all-important November Fed meeting. Now, the S&P 500 futures pretty much unchanged. If you look at some of the pricing out there, so it's all about margin, so we look ahead to earnings season. Let's break it down now and look at the various indices depending on the countries that they're looking at. So if we bring the map up, it'll be a good indication to see, for example, if the commodity-rich UK is unchanged. Again, the focus is not only on inflation, but on growth going forward. A bit of pressure you can see on the GAC and the DAX over in Germany, the Ftse MIB practically unchanged. Now, the U.S. Senate has approved a short-term debt ceiling increase, breaking a weeks-long standoff that rattled financial markets. While it actually grants the U.S. a temporary reprieve, investors are now on watch for the September jobs report. They'll be assessing whether the abrupt decline in hiring in August was a blip or something with staying power. Well, joining us now is Bloomberg's Stephanie Baker with the very latest on this. So, Stephanie, good morning. What's the significance of the Senate vote to lift the debt limit until December 3rd?
Right. So this basically just delays the crisis, kicks it down the road. It doesn't solve it ultimately. Remember that lifting the debt ceiling doesn't actually cost money. It's not actually adding debt. It just allows the government to pay for the spending that Congress has already authorized. Now, Republicans have been filibustering this for weeks now. McConnell made this offer to drop the filibuster and let Democrats raise the ceiling, but only until December 3rd, which is the same day that the government runs out of money. So Democrats are saying that McConnell blinked. Mitch McConnell, the Republican leader in the Senate, even Donald Trump is saying that McConnell folded. And I think the significance is that over the next 2 months, Democrats will be trying to pass Biden's big economic package, pass the bipartisan infrastructure bill without the threat of default hanging over them.
So, Stephanie, why exactly did the Republicans, Mitch McConnell, agree to this?
Right. So this gets really complicated, but basically the Republicans want the Democrats to lift the debt ceiling through a complicated process called budget reconciliation, so that they can pass it without any Republican support. The Democrats would be able to do that just with the simple majority that they've got in Congress. Democrats don't want to do it this way because if they lift the debt ceiling through budget reconciliation, you have to lift it by a certain amount, not to a certain date. And I think they're worried that this will open themselves up to attack by Republicans in 2022, saying Democrats have, agreed to spending trillions and trillions. It doesn't seem to make much sense because that will most likely be the line of attack by Republicans, whatever happens. But basically, we have a kind of high-stakes gamble over the next few months trying to get all these bills passed. Democrats could potentially lift the debt ceiling through budget reconciliation as they pass Biden's big economic agenda. But the question is, what do Republicans do on December 3rd? Do they allow that to go through? Do the Democrats agree or not?
Yeah. Stephanie, thank you so much. Stephanie Baker there with the very latest on the debt ceiling. Now, today's jobs report from the U.S. will also be key for investors to assess whether the abrupt decline in hiring in August was a blip or something with staying power. For more, let's get straight to Bloomberg's Ritika Gupta. Ritika, good morning. This is extremely important because it's also the last piece of data Fed members have before going into that November meeting.
Yeah, Francine, and of course we got that big downward surprise in August, just adding 235,000 jobs, but much more optimistic going into September. The media expectation is that we'll add 500,000 jobs. The unemployment rate expected to tick lower to 5.1%, and the participation rate, very much watched as well, to rise to 61.8%. Now, we are much more optimistic going into this, of course, after a stronger than expected ADP report for the month of September, and also those jobless claims that we saw yesterday, the lowest in a month. So this is an expectation now that those unemployment benefits rolling off and children going back to school, that'll start to feed into the data. But there is a source of uncertainty. That is, of course, the hospitality and leisure sector. That had zero growth in the last report, of course, and that was a big account for the miss that we saw. So we'll be watching to see for that as well, Francine.
So, Ritika, could the numbers actually divert the Fed's course to taper?
Well, after September, Jay Powell did say he doesn't need a strong employment number, but it needs to be decent. So the question really is, what is that range that amounts to decent? Of course, if we got 500,000, the expectation or more, that's pretty much the green light to the Fed to stick on its course. But as you can see from this chart here, our expectations, so this white line here and the orange bars, what we get in reality, can often very much diverge. But Evercore are going so far as to saying that even if we did get a jaw-dropping number of just 235K jobs added, that would still be enough for the Fed to stick with its tapering plans. Francine.
Ritika, thanks so much. Ritika Gupta there with the very latest on the jobs report. Now we're joined by Joe Little. He's global chief strategist at HSBC Asset Management. Joe, thank you so much for joining us. I have a lot of questions on inflations, but maybe let's start off with the U.S. jobs report. What kind of an indication are you expecting, the jobs report to tell you about the strength of the U.S. economy?
Well, like you've been talking about, our expectation is something around 500,000 as the run rate that we are expecting going through the fourth quarter. I think that tells us, if that's delivered, that we're in this early part of the middle of the economic cycle, what we call the expansion economy. That's the phase of the cycle where we should see still good growth. Growth has peaked, clearly. Profits have peaked also. But growth is still good enough to improve the labour market and proceed that gradual process of labour market healing, bringing people back into the labour market. I think, as you've mentioned, the key issue really is what happens to labour supply. Do we see the various developments around the Delta wave peaking, the unemployment insurance top-ups rolling off, childcare provision also being more readily available? Does that encourage more people back to the labour market? So like you've been mentioning, the participation rate is really going to be a key variable that we're going to be watching alongside all the other information in the payrolls numbers.
Joe, overall, what do you think is moving the markets right now? So we thought that there was little in the deficit, and we see a little bit of a lift on the back of that, at least being extended for a couple of months. But is it the inflation worry? Is it supply chains? What will it take for the market to correct at this point?
Well, I think what you've seen in the equity space is there's been quite a lot of sensitivity to higher real yields. So the equity wobble that we've seen is really very much connected to that environment of higher bond yields, higher real yields, US real yields moving higher. That does seem to really be having an effect on how equity market participants, investors are thinking about equity risk at this point. We are seeing policy normalization everywhere you look. If you look east, we're seeing rate moves. If you look west, we're seeing the discussion around tapering. And I think that is to be expected at this early part of the middle of the economic cycle. Policy normalization comes very much on the agenda. And that creates a little bit of a challenge for equity markets because it does change the drivers of equity performance. It's no longer about multiples re-rating. In fact, typically at this phase of the cycle, what you see is some pressure on PE multiples, market multiples broadly, and that's coming from either higher bond yields, higher real yields in particular would be the part of the market that I would be watching most closely, or it could come also from a shift in perceptions about equity risk. So earnings become a key driver as well, Francine, because we really are relying on good profits being delivered to the system, evidence of that coming through in order to make sustained gains on equity markets.
Joe, thank you so much. We'll talk a lot more about some of these earnings. I'll talk to you about industries and, of course, what we do with some of the margins. That is Joe Little, Chief Strategist at HSBC Asset Management. Now, Mervyn King tells his program that inflation risks tilt to the upside. Up next, we discuss the next steps for the UK and the Bank of England with Joe Little of HSBC. This is Bloomberg.
All these attempts to revise frameworks for monetary policy, average inflation targeting, just out of the window, basically, because the idea that you can gradually control inflation to let it go above target a little bit for a short period and then bring it back doesn't square with what happens in the real world. So I think being alert to the data, some of the upward pressures will be transitory, but the real risk is that it gets embedded into upward pressure on wages. That's going to be the thing that central banks will focus on.
Well, that was former Bank of England Governor Mervyn King, Lord King, speaking to this program yesterday. A lot of inflation, of course, saying that this is the one mistake that maybe central banks could be looking at. Let's go back to Joe Little. He's Global Chief Strategist at HSBC Asset Management. Joe, I'm not sure what to do with inflation because central banks keep on saying, look, it's transitory, but actually the market starts to think otherwise. And then we have warnings from certain data points saying that this could be much stickier for much longer inflation. Is the UK worse off because of the inflation prospects than other parts of the world, or is this a global problem?
Well, I think it's a great question. So there's a number of supply chain disruptions that are very evident post-COVID. And I think it's important to remember that when we think about the inflation picture. So we've got this issue around very strong goods demand, very strong goods consumption. We've got macro reopening, creating demand-supply imbalances and mismatches in some markets for some types of workers. And we've got the challenge around labour supply. Labour supply hasn't returned at high numbers so far. But as I say, I expect that to improve as labour markets begin to heat up. So I think there is some evidence that supply chain disruptions are beginning to ease. We might be at the peak of some of those issues, at least on some pieces of the macro data that we look at. But it is right what you say, Francine, that the UK, albeit facing many of those global challenges like other advanced economies, also has the issues around the Brexit shock to deal with alongside that. So we've almost got two supply side shocks in the UK coming together. And what's interesting about that is that they're not additive, they're multiplicative, and it becomes very complex in terms of thinking about how they are going to reinforce each other and create some bigger challenges for the supply side in the UK. So I wouldn't go so far as to say the UK is a sort of a canary in the coal mine for the rest of the global economy, but it could be a bit of a special case.
So, Joe, what does it mean for asset allocation? Do you actually stay away from the UK and decide to put your money elsewhere? We're also talking about earnings. So talk me through some of the dynamics of the sectors that you like as well.
Yeah, sure. I mean, the UK equity market is disliked by investors globally. And it has been shunned now, maybe linked partially to the comments I just made, but many global investors haven't focused on it with maybe the attention that it probably deserves. What we see in the UK is that it does have a very strong tilt and bias towards cyclical and value parts of the equity market, value names and cyclical names. You know, that makes sense when you think about the financials, the energy names, the commodity, industrials, and so on. So it's quite interesting from an asset allocation perspective because it becomes a bit of a pure play on a reignition of growth. So if you have the view that we are going to see agile policymakers globally beginning to adjust appropriately in the event of any growth shock, similar to what we've seen in China, then maybe value can again perform, and the UK equity market could do rather well in that environment.
Yeah. Joe, thanks so much. Joe Little there, Global Chief Strategist at HSBC Asset Management, joining us today. Now, coming up, nearing a global tax deal, the OECD meets today as Ireland removes another hurdle to an international accord. That story up next. This is Bloomberg.
I don't think that the current American situation could be a hurdle in the way to a compromise and a final agreement on all the technical parameters of this new international taxation system.
A lot of work has been done. We're very close. Conversations are continuing. As I stand here today, I'm quietly optimistic that in time for the G20 Leaders Summit, we will be able to finalize an agreement.
I share the quiet optimism. This is a once-in-a-generation opportunity. It's a once-in-a-generation opportunity to make the international tax system fair.
Well, some key voices there on the final stretch towards a global tax deal. The OECD meeting today is expected to unveil some kind of agreement. A big hurdle was lifted yesterday, with Ireland actually saying it's ready to sign up to the agreement. Well, joining us now is our reporter in Paris, Kailey Leinz. Kailey, thank you for joining us. So first of all, how important is Ireland's announcement?
It is quite historical because obviously Ireland has had this 12.5% corporate tax rate for a generation, and that is what has attracted all the US big tech to Ireland. Of course, IBM has been there since the 1950s, but more recently, Google, Facebook, LinkedIn, TikTok, they all have their headquarters and their presence in Ireland. Just to give you an idea, the top 10 foreign multinationals represent about half of Ireland's corporate tax revenue. So it is a little revolution. The reason why Ireland didn't agree initially at the G20 Finance in Venice in July is because in the initial deal, you had the word at least 15%, meaning this corporate tax rate could go higher. France was pushing for a higher rate, for example, of at least 20%. Yeah. So last night, Ireland said that they secured the removal of this wording at least 15%. Still, they're going to lose about 2 billion euros in corporate tax revenues, but they say that Ireland also has other things to attract US big tech, such as the workforce, the GMT, timing, and also the fact that they are still in the EU.
So, Kailey, does that mean that a global tax deal now is almost a done deal? Is it a done deal?
It is not a done deal. It is getting closer, though. Hopefully, they will sign off with the G20 leaders in Rome at the end of October. But some hurdles remain. First, some countries, such as Poland, are pushing to exempt some economic activities. And that could mean that a final agreement could be applied partly on tangible assets and partly on payroll. Some countries like China are concerned about these companies with big revenues, but only very small subsidiaries abroad, because obviously this is also going to impact some Chinese companies such as Tencent or China Life Insurance, for example. And then you have the issue of how to share profits from digital taxation. And finally, of course, in the longer term, even if they sign off a deal at the end of the month at the G20, you've got the issue of ratifying in different countries. Right. And the US Senate has threatened to block ratification. So still a long road ahead for this global tax deal.
Kailey, thank you so much. Bloomberg's Kailey Leinz there in Paris for us. Now, don't miss our interview with Ireland's Finance Minister. He's Paschal Donohoe, and it's later this morning. Now, let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Hi, Francine. The Senate has approved legislation which pulls the U.S. government back from the brink of a payment default. The 50-48 vote, with no Republicans in favor, raises the limit by $480 billion, allowing the Treasury to meet obligations until December 3rd. The legislation is expected to pass the House, which could vote on it next week. Former U.S. Treasury Secretary Steve Mnuchin is warning about the risks of borrowing and overspending by the Biden administration and concerns it could further fuel inflation. He told Bloomberg's David Weston the U.S. needs a discussion around the appropriate levels of national debt.
The good news is the economy is rebounding very strong. Labor prices are up. So I do worry that this will be ongoing inflation, and we could easily end up with 3.5% 10-year treasuries, which again just increases the cost of the national debt and creates budget issues.
Armin Laschet has signaled he's prepared to step aside as the head of Germany's CDU after the Conservatives' electoral defeat last month. In a video call with party members, Bloomberg understands Laschet said the CDU needs new blood across the board. Meanwhile, the Social Democrats say they got off to a good start in the first coalition talks with the Greens and the pro-business Free Democrats. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Laura, thanks so much. Now, coming up, crypto's $69 billion mystery as a stablecoin, Tether, is supposed to be backed by real U.S. dollars. But as the currency grows exponentially, what's really behind Tether remains unclear. We'll have that story shortly. This is Bloomberg. Default averted for now. The U.S. Senate passes a short-term debt ceiling increase until December. Investors look ahead to U.S. jobs data. China back in play, returning to the market after a week-long holiday. Services data beats, stocks rise. The PBOC drains cash from the banking system. And Tesla moves to Texas. Elon Musk tells investors a shortage of chips and ships are the company's top threats. Well, good morning, everyone. Welcome to Bloomberg Surveillance Early Edition. Happy Friday. I feel like it's been a long week, not just for me, but for everyone in the markets. I'm Francine Lacqua here in London. So this is what the markets are doing. Pausing for breath, but also they're a little bit directionless. Of course, we look at the U.S. jobs data. It's the last significant piece of data before then that November meeting of the Fed, where there's wide expectation of tapering. The other thing we're watching out for is energy prices. They do seem to be stabilizing. China, after a week-long holiday, also stabilizing. So investors, as you know, watching today's jobs report closely to assess whether the abrupt decline in hiring in August was a blip or something with staying power. Let's get straight to Bloomberg's Mark Cudmore. I'm so excited that Mark is here in London in the studio. Mark, when you look at what the market is looking at, so first of all, are you surprised that they were looking at the U.S. debt ceiling? It's unclear actually what was priced in and how much, of course, is the focus on this jobs report.
So I think about the debt ceiling, I think it's all been about the relief that the tail risk has been removed. I don't think the debt ceiling was really responsible for the nervousness we've seen in stocks. Other stock markets fell more than the S&P 500 in recent weeks. So I think that it was just, yes, it's a relief that it's been resolved, but it's only been kicked 2 months down the road. I think traders were always thinking next week we'll panic about the debt ceiling as we get to within a week of the supposed October 18th date everyone was talking about. Now we know it's 2 months away, so I don't think it's changed the game much.
So, Mark, on the U.S. jobs report, I know that there's such a belief, actually, from the markets that inflation is here and is stronger. Is the Fed itching to taper no matter what the jobs report says?
It's a good way to put it. I think they are, basically. I think, but it's important to emphasize they're not itching to tighten policy. I think they stay adamantly dovish, and I think they're trying to be very clear to say tapering isn't a hawkish message. I don't think they're itching to hike rates anytime soon. Don't think that's why they want to taper. It's just there's too much liquidity in the system. We know this, and like part of the problem, we've got an inflation problem. Yes, it's more asset price inflation, but it's their liquidity they're providing through tapering, so they do need to withdraw that.
I had a long conversation yesterday with Mervyn King, and he says, look, we're just measuring things wrong. You can't rely on forecasts to tell you what inflation is because it changes so quickly. Could we really look at a massive worldwide central bank policy mistake?
I think absolutely that's a risk. I want to make sure that I'm very clear to say that's not necessarily my base case scenario, but I think it's a very severe risk. If I put an arbitrary number in it, I think it's more like a 30% risk, not a 5% risk, not a 6%. So it's a serious one we should be considering. Definitely, this is an inflationary environment which none of us have traded because we haven't seen something like this in 50 years. So, in fact, even more than 50 years, it's many measures, it's worse than some of the 1970s shocks in terms of energy and oil. So I think this is a really, really rapid change in prices, and there's a chance that central banks are getting it wrong. I agree in the argument that there are structural disinflationary pressures, but maybe that gets overcome, as you've kind of implied, this idea that you shouldn't look at forecasts, we just start feeding into this kind of expectations from consumers, we get the rise in wages, and that starts a spiral that we cannot stop easily.
So if we do get that spiral, what would be the ideal way of a central bank to rein in policy? I mean, do they have to then hike aggressively with a repricing and risk a repricing of the markets?
I think that if assuming we get that negative scenario, and I should say that's not my base case.
Yeah,
that
30%.
I think if we get that policy mistake, and I think it'll be another 6 months before we see that. I don't think we're going to suddenly decide that in the next month or so. If we suddenly go, oh my God, inflation really is taking off, we've got a dangerous spiral, we're going to have something like a Volcker moment.
Yeah.
Obviously from a much lower base. So I don't think we're going to suddenly get interest rates back up to 18% or 20%, but I think, we could be getting interest rates significantly higher, and that's going to just cause chaos around the world. I would reiterate it's not my base case, but it's that threat that I think people are still complacent about.
30% is still, breaking news for
Maybe
me.
I've gone too high, 30%, but I think it's a sizable risk.
Talk to me a little bit about China. So you're a great student of China. You understand China more than most. When you look at Evergrande and the stabilization, certainly today after a week holiday, again, is there false expectations that everything is okay, or should we really still be on edge?
So actually, I've got the opposite view here. So while I think we're perhaps a little bit too complacent about the tail risk on the inflation side, I think the China risks are discounted already. I think it's in the price. And you can see that in the price action in the last couple of weeks, that we've had a negative environment globally in sentiment. Global stocks been selling off, but actually China, Hong Kong haven't been going any lower in the last couple of weeks, despite the fact that the Evergrande situation's been escalating. There's the Fantasia default. And I think we've actually reached kind of excess pessimism in China. There's no particular reason to get excited on the top side, but I just think that it's hard for it to fall in isolation. It's not going to lead to any declines in sentiment now.
So what moves the markets from here? So we also have earnings possible, because of energy prices, a little bit of pressure on margins. Apart from the inflation debate, and China, which you think we're overdoing, what are you watching out for?
So obviously inflation and China are the big ones. I think it's interesting you mentioned earnings, because at some point, at the moment, we've seen corporates being able to pass on the input price increases, and therefore they've been able to maintain a lot of those kind of margins. And as you say, we're getting some pressure there. But at some point, this is a bad cycle for equities if they actually don't get compression in profits. Because if they don't, that means we are in a proper inflationary cycle. So this is going to hurt equities at some point. It's which way it hurts them. Does it hurt them through profit compression because they can no longer pass on those costs? Or does it mean it hurt them through inflation because they keep on passing on those costs and we start an inflationary cycle? Actually, longer term, it would be worse for them if they continue passing on costs, because then we get a real inflation cycle.
Are we underestimating the impact that energy prices actually have on companies?
Are we underestimating it? It's certainly a big issue. I think we're starting to realize that. I think that's part of the negativity at the moment is oil prices are pushing so far, and obviously the gas price situation in Europe is massive. I think if prices are still up here, we thought of 100 pence a therm as being a high level, and I think we thought that would be a crisis. We breached 400 this week. I think, if we stay up above 200 into Christmas, I think it's going to be really tough for a lot of industry.
Mark, thanks so much. Mark Cudmore there. Of course, he's in charge of MLive. It's a wonderful blog. I urge everyone to go and check it out. Mark and his team do some wonderful work. Now, is a stablecoin, or is it a stablecoin or a hedge fund? There are 69 billion tethers in circulation, with each coin worth $1. But where does Tether actually keep the dollar it gets from traders? That's a big question posed in a Bloomberg Business Week story, which you can read online and on the terminal. So joining us with more on this to discuss stablecoin is Bloomberg's Joanna Ossinger. Joanna, great to speak to you on such a fascinating story. So if you set the scenes for us, what exactly is the concern about Tether?
Hey, Francine. So Tether is a stable coin, which is designed to be one-to-one to the US dollar. It's the biggest stable coin in the world. It's used in many crypto transactions worldwide. It's kind of really in the plumbing. And at the beginning of the year, it was about $21 billion, or 21 billion tethers were in circulation. And now it's close to 70 billion. So it's really becoming more of an issue where people are wondering if it's a systemic thing they have to worry about. So we're paying a lot more attention to what it has as reserves. And that's how this story came about.
So what does Tether actually use as its reserves?
Yeah, well, Business Week actually obtained a document that shows that Tether's reserves include billions of dollars of short-term loans to large Chinese companies. That's something that, say, money market funds have avoided. Tether has denied holding any debt in Evergrande, the troubled property developer, but its lawyer declines to say whether it has other Chinese commercial paper. And he says the vast majority of its commercial paper has high grades from credit rating firms.
So, Joanna, what do we actually know about whether, keeps some of its reserves?
Yeah, well, we know about where Tether keeps some of its money, for instance. The chairman of Deltec Bank and Trust in the Bahamas says he's held only cash and extremely low-risk bonds for Tether. But recently, he says, the company started using other banks to handle its money. So Deltec has about a quarter of Tether's money, about 15 billion or so.
Joanna, thanks so much. Bloomberg's Joanna Ossinger there joining us on this very important story. Great piece on Bloomberg Business Week. Now we're just getting some breaking news out of China, finding Meituan 3.4 billion yuan in an anti-monopoly probe. I mean, this just goes back to some of the things that we're seeing out of China. I don't think it's moving the markets at all at the moment, but if it does, I mean, a lot of them are closed, but it just is a quite significant amount, so it's good that we bring you that breaking news. Coming up, driving east, Tesla announces it's moving its headquarters from California to Texas, so we'll discuss Tesla's AGM next. This is Bloomberg.
With Extreme, we're kind of bringing together the blue planet with motorsports, because we are racing in like extreme locations where the damage of climate change can already be felt significantly.
With love for our planet, Zurich Insurance, sponsors of Leaders with Lacqua Goes Green.
Giga Shanghai has done an incredible job, and Giga Shanghai now exceeds Fremont in production. So actually, I'd like just to give a special hand to the Tesla China team. We will be continuing to expand our activities in California. So this is not a matter of sort of Tesla leaving California. As I said, our intention is to actually increase output from Fremont and from Giga Nevada by 50%. So, but we're just hitting the sides of the bowl.
Chief Executive Officer Elon Musk there announcing a move of Tesla's headquarters to Austin, Texas last night during the electric vehicle makers' shareholder meeting. Now, a global shortage of chips and ships is the only thing standing in the way of Tesla maintaining sales growth in excess of 50%. According to the chief executive Elon Musk, supply chain challenges are the biggest threat to future growth. But shortages don't appear to be slowing Tesla down just yet. The company reported record deliveries of 241,300 cars in the third quarter. Well, we're now joined by Miranda Braun, non-executive director at the electric vehicle manufacturer Switch Mobility. Miranda, great to have you in the program. Thank you so much for coming on. Okay, I have a million questions about Switch Mobility, but first, Elon Musk and Tesla. Is there a global chip supply problem that will affect electricity vehicles more than others?
There is clearly a chip problem at the moment, and a chip storage problem, and it hasn't really affected. When you look at the sales for Tesla, they are having record-breaking sales. They've just had their best quarter. So I don't think for now there are any long-term issues, but we'll have to wait and see. How long will this issue last? We'll have to wait and see as well, with regards to that. But I think just in light of the fact that when you look at the electrical vehicle industry overall, we've just had the record-breaking month. We've had 33,000 electrical vehicles that have been sold in September 2021. In comparison to September 2020, that's an increase of 50%. And when you look at 2019, that nearly covers the whole of 2019. So this certainly doesn't seem to be slowing down the electrical vehicles from a sales perspective and from a manufacturing perspective, but this is something to be mindful of going forward.
So, Miranda, what does the electric vehicle industry need right now? Is it infrastructure? Is it, making sure that you can power your car faster? Is it batteries? Is there a component that basically we're missing that could, spell a hiccup ahead?
Definitely batteries. There is a focus on batteries. There's also, when it comes to the charging points, we need to have more investment in terms of the technology. We need some government assistance with regards to that, because when you're looking at consumers and looking at Switch Mobility, we focus on e-buses and e-vans. Yeah. And one of the things I loved about Elon Musk's AGM from last night is that he mentioned that they will be expanding to all different vehicles. And I think when you're looking at electrical vehicles, this is something that will be covered across the whole spectrum. Looking at electrical vehicles as well, though, there is a price reduction point when you look at this long term. There's the service costs as well, which are a lot cheaper. Looking at e-buses, there's a noise reduction, so that's also for the well-being of the bus drivers. So I think long term, we definitely have a great future when it comes to electrical vehicles. We've seen from the UK fuel crisis that we've had more orders come through with regards to that. One of the things that highlighted, though, for years we've been talking about electrical vehicles and how it's really important for the environment, of course, for sustainability. But what we found over the last month and the last few weeks is that the consumers are more concerned about the convenience. And so it's more a case of, I don't want to queue, I don't want to have a punch up. And so for them, it seems to be more on the convenience side. Of course, there are consumers who are concerned about the environment, and there's that driving factor as well, which is very, very important.
And subsidies. I mean, if you pay 15, 20 pounds every time to get into London, it's cheaper to have an electric car, and that will probably make a difference to people's minds. How much are you expecting electric vehicles, buses, public transport to increase compared to private consumption vehicles?
Yeah. Well, if you look globally at the moment, we have 600,000 e-buses around the world, and that's set to increase by another 230,000 by 2027. Now, when you look at London, which is where we are at the moment, in London alone, we have 3,000 e-buses, and that's set to increase by nearly 10,000 across the next 10 years. And so there is definitely a demand, not just with e-cars, not just with e-trucks, e-vans. I know Elon Musk mentioned planes and boats as well, but there is definitely a demand when it comes to the e-bus industry, and that's something that Switch Mobility is at the leader of. We're looking to become the #1 European leader. We have a global outreach across 40 different countries, and what's also very innovative about the e-buses that Switch Mobility produces is that the e-buses that they're producing, it has a lifespan of 25 years. When you look at the average e-bus at the moment, the lifespan is only about 7 to 8 years. So we're very innovative in that respect. There's also the lightweight design. Most buses are very heavy with a diesel, there's lots of noise. There is a noise reduction attached to the e-buses as well. So there's definitely an attractive focus there.
And Miranda, thank you so much. Miranda Braun, their non-executive director at Switch Mobility, talking about some of the things at Switch and also giving us an overview of the sector as a whole. Now let's switch focus to China. After months of resilience in the face of concern over China Evergrande Group, the country's $12 trillion domestic credit market has begun to show signs of strain. Now, for more, let's speak to Bloomberg's John Liu in Singapore. John, great to speak to you. How much of the focus is actually on now some of the worries on China being overdone, and how much of it is, there's still going to be bumpy roads, but overall, some of the authorities will manage it?
I think there's going to be bumpy roads. I think what markets are thinking about now is that there's lots of incentive for Beijing to make sure this thing does not get out of control. But I think there are still issues that everyone is paying attention to. For example, we had some statistics out today that sales by the 100 largest developers in China during the month of September, they fell 36% from last year. And so you can see how much of a fall there's been in demand for housing, and obviously the ripple effects for how those developers are able to service their debt.
So, John, what are you looking at? We had Evergrande. We have a couple of other things, Fantasia. Is there anything else that you would be looking at to make sure that the authorities are letting off a little bit of steam without, whilst at the same time avoiding something that could be catastrophic?
So today, the central bank, during its open market operations, actually withdrew liquidity from the market, the largest net amount taken out of the market in the last year. That, I think, speaks to a level of comfort that Beijing has with the current situation, that it doesn't need to provide this additional cushioning for the market to get through this period of stress. The other thing I will look out for is Evergrande missed its first payment on the 23rd of September. It had a 30-day grace period for that coupon. That's coming due at the end of this month. If it doesn't make the payment, then it could actually be in technical default. So that will be an important point to watch out for.
John, thanks so much. John Liu there, our executive editor in Beijing. Now, later on today, we'll be speaking with the U.S. Treasury Secretary Janet Yellen, ECB President Christine Lagarde, and the Amazon Executive Chair Jeff Bezos. That's the B20 summit. I'll be moderating that. It's going to be a fun conversation. The focus, of course, will be on monetary policy, central banks, and then Mr. Bezos will weigh in on the race to space, but also a couple of things in his initiatives. That starts at 1 p.m. London time, 8 a.m. in New York, and you can catch that live on Live Go on your Bloomberg terminal. This is Bloomberg.
There's no question we have inflation today. The Fed models and the Treasury models don't necessarily are able to predict what's going to happen in the future because, again, of the extreme fiscal and monetary response. My concern is that we will have inflation. This inflation will continue. Some of it may be transition, but look at energy prices. I mean, something I never thought we'd see during COVID is you saw negative prices of oil. But now the Biden administration is talking about releasing oil from the strategic reserve. Clearly, we have inflation in energy. The good news is the economy is rebounding very strong. Labor prices are up. So I do worry that this will be ongoing inflation, and we could easily end up with 3.5% 10-year treasuries, which again just increases the cost of the national debt and creates budget issues.
Well, that was the former Treasury Secretary Steve Mnuchin on the possibility of 3.5% treasuries. Now, Newcastle United has a new owner, and long-suffering fans are delighted. Human rights activists, not so much. The now completed takeover by the Saudi Wealth Fund would realize a long-held dream of the supporter base, rid the club of 14-year owner Mike Ashley. But Amnesty International has dubbed the £300 million move as sports washing. Well, joining us now for more is Bloomberg's Laura Wright. So, Laura, exactly what's happened and how significant is this deal?
Hi, Francine. Well, Saudi Arabia's public investment fund, they led a consortium of investors acquiring Newcastle United, purchasing 100% of the shares from the former owner, Mike Ashley, a billionaire and the founder of Sports Direct. So the structure looks something like this. The public investment fund owned 80%. PCP Capital Partners, owned by Amanda Stavely, who was instrumental in brokering this deal. She will become CEO and take a 10% stake. Finally, the Rubin brothers, with their RB Sports and Media, will have the final 10% stake. And really, this cements Newcastle United's position as one of the world's wealthiest football clubs.
So what's exactly happening? I mean, the deal is pretty significant. And you were mentioning there Amanda Stavely. How did the deal come about, Laura?
Well, it's been in the works for around a year and a half. And actually, this same consortium almost came to a deal a year ago, but that was scuppered because of accusations that Saudi Arabia was illegally pirating Premier League football content from the Qatari-owned beIN Sports. beIN Sports was actually banned in Saudi Arabia until a few days ago. They've since come to an agreement, which is how this deal was able to materialize so quickly.
Thank you so much, our reporter there, Laura Wright, on this pretty significant deal. I'm so glad we're putting the spotlight on it. Now, Bloomberg Surveillance Early Edition continues in the next hour. Danny Berger joins me here in London. Kailey Leinz will be in New York. Now, we have the Nobel Peace Prize. That's coming up in a couple of minutes. Of course, we have a full market reaction from the U.S. jobs data a little bit later. And then I'll also have a pretty good panel for the B20 with Janet Yellen, Christine Lagarde, and then later on, we'll also speak to Jeff Bezos. So it's going to be a busy Friday, but everyone, at least we've made it to Friday. So happy Friday. Markets next. This is Bloomberg.
We have reached agreement to extend the debt ceiling through early December.
The pathway our Democratic colleagues have accepted will spare the American people any near-term crisis.
Some of this is a bigger picture, longer-term issue that's going to take years and years to address.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, October 8th. Our top stories today. Jobs Day drama, only a major miss in U.S. unemployment report would shake up investors counting on the Fed to start tapering next month. We'll have the numbers at 8:30 a.m. New York time. Back from the brink, the Senate passes legislation that would actually avert a U.S. payment default, but only for a couple of months. The U.S. House is set to vote next week, and clearing a big hurdle to a global tax agreement. Ireland's ready to abandon its corporate tax rate and sign on to a higher one. We'll talk with the Irish Finance Minister. Well, good morning, everyone. I'm Francine Lacqua here in London with Danny Berger. Kailey Leinz is in New York. Matt Miller is off. Kailey, we talked about the markets. We're also expecting the Nobel Peace Prize to cross the Bloomberg terminal shortly. It's always exciting. And actually, this year, there's a number of contenders from very different walks of life. When you look at markets, they're pretty much stable. But of course, they're waiting for this U.S. jobs report to really have an indication of what happens with Fed tapering.
Yeah, exactly. Only about 3.5 hours to go until that print. So we are all waiting and watching. As for what happened in the Asian session overnight, it was a positive one for stocks. A lot of green on the screen when it comes to the major equity benchmarks, but it was a down day for Asian currencies and bonds, and you can see a beautiful picture of that at GMM Go on the Bloomberg terminal. Now, of course, Chinese stocks opened back up after a week-long holiday, and in a positive way, even though the PBOC drained the most short-term liquidity out of the system in a year. Now, that move in Chinese stocks was actually led by the consumer sector. The discretionary index of the CSI 300 up about 3% on the day. Chinese bonds, though, definitely did feel some of that liquidity drain. The Chinese 10-year yield up about 3 basis points. It's back at 2.906%, which is the highest going back to July. In other asset classes, I would note that metals and a lot of the commodities are getting a lift as China reopened, including iron ore, which futures were up 6.4% in Singapore. And then broadly, most Asian currencies weaker against the dollar today, but the Japanese yen is actually the biggest underperformer in the G10 space. No real desire for that kind of haven bid today. It is weaker against the dollar by 0.25%. Now, here in the U.S., we are coming off 3 consecutive days of gains for the S&P 500. The question is, can we make it a fourth? And right now, it is looking a little bit uncertain, as S&P 500 futures are right now down about 0.2%. Of course, it really is all going to be about the jobs report today and what it means for Fed tapering. Now, ahead of that print, I would note yields are moving higher. We're up 2.5 basis points on the 10-year Treasury. Right now, we are sitting at 1.5978%, very close to the 160 level that strategists say could trigger some convexity hedging and mean the sell-off is exacerbated. So keep an eye on that. We do have a stronger dollar this morning, and oil, Danny, $79.50 on WTI. We are back at the highest since 2014, heading for a 7th consecutive weekly gain.
The doomed convexity hedging. Well, certainly some of those fears filtering through to the European session as well. Not getting too much movement. It is reflected sort of what the U.S. is doing, that we're waiting and seeing what the jobs report will be. But we're looking at most of these markets down about an average of 1 to 0.2%. I love how Sebastian Gailey over at Nordea puts it, that we are in a fog of uncertainty in these markets. Yes, the jobs number might give us some clarity, but we still don't know the solution to things like supply chain issues and inflation. So what's outperforming? Things that do better with higher yields. So banks outperforming, hence why the Ftse MIB pretty much unchanged for the day because there's so many banks there. DAX declining about 0.25%. CAC Arone down about 0.3%. One of the few indexes to move higher in the region is the Ftse 100. That's up just 0.08%, so not even up by 0.1%, but this is really just to do with the currency effect. A weaker pound today is going to translate into those multinationals performing better today. So here's the cable rate, the second to the last one here. That's 136.05. A lot of that having to do with the stronger dollar, but I should say pound is still underperforming the euro as well. Now, part of what's contributing to that is much of what you were pointing to in the U.S., Kailey, and that's this move higher in bonds. Now, I have both the Bund here and gilt, so you can compare just how much more of movement we're getting in the U.K. 10-year gilt yield up 5 basis points compared to 3 for the Bund. These are still pretty substantial moves for both of them, but it really has been this U.K. market where inflation is the fear, the idiosyncratic issues having to do with Brexit, the fuel shortage there. But one positive UK story is everything in the travel and leisure sector. TUI, which is a vacation company, they do flights, hotels, all of that kind of hotel packages for UK consumers, up nearly 2%. Francine, the UK paring back its list of places where you need to hotel quarantine once coming back. Now only 7 countries on that list.
we're also, so we keep, of course, an eye, a very close eye on the markets. Danny, we also just got breaking news out of Oslo for the Nobel Peace Prize actually being given to two journalists that have fought for press freedom and, of course, gone around some authoritarian regimes. So this year's winner of the Peace Prize, Nobel Peace Prize, has been awarded for efforts to safeguard the freedom of expression and a precondition for democracy and lasting peace. Maria Ressa and Dmitry Muratov have been awarded the Nobel Peace Prize. This is quite significant. Last year, a reminder, it was the UN's World Food Programme that was given the prize. I know Maria Ressa's work. There was a lot of focus, of course, against Mr. Duterte, and one of the biggest critics, of course, to that, Mr. Muratov, speaking a lot against Russian oppression. So we'll have a lot more, of course, on this Nobel Peace Prize. Now look at what else is ahead today. 8:30 a.m. New York time, we get the U.S. jobs report. The data could either help cement or deter the Fed's taper timeline, currently set to begin as soon as November. There's also a meeting of the OECD countries on global tax. Ireland's decision to sign up to a global minimum corporate tax rate of 15% has removed one hurdle to a deal. And then a little bit later today, we'll also be speaking with the U.S. Treasury Secretary Janet Yellen, ECB President Christine Lagarde, and the Amazon Executive Chair Jeff Bezos at the B20 Summit. I'll be chairing that proceeding, and it starts at 8 a.m. New York time. Now, starting in Washington, the Senate passed a bill that raised the government's debt limit through December 3rd, breaking a weeks-long standoff that rattled financial markets. Let's get straight to Emily Wilkins, Bloomberg government reporter, joining us from Washington. Emily, why do we finally have a deal? What is the Republican thinking on this?
So the Republican thinking is that Democrats were saying that Republicans weren't giving them enough time, that they needed more time. And so the Senate Republican leader, Mitch McConnell, said, fine, you guys have more time. You're going to have until December 3rd. But look, we're not really budging from our position. We're not going to help you raise the debt ceiling in the long term. We'll do short term right now. But long term, it's all on you. We're not going to touch it. And you know, Republicans will not be having the votes. And so to a certain extent, Democrats and Republicans, they've just delayed this stare down that they were in for the last week. There's still a big question over exactly how you raise the debt limit. I mean, one side is going to have to cave on what they are wanting here because Democrats do not want to use that Democrat-only process, that reconciliation process to raise the debt limit. It would require them to actually name the amount they're raising the debt limit to. And there's a definite concern that that number is going to show up in a lot of campaign ads next year.
Well, and Emily, the House will come back to vote on this on Tuesday. After this is all said and done, what is the next item on the agenda in terms of priorities?
So for the House and for the Senate, the new deadline for that infrastructure social spending tax plan, that is coming up on October 31st. We did see lawmakers make progress last week in their negotiations. They're still having discussions this week. But once again, everyone's going to be away from Washington next week, save for that very short time. The House will be back on Tuesday night just for the debt ceiling vote. And there's a lot of questions about whether a package is going to be done by that point. You see the parties still pretty far apart. You see a lot of questions about what needs to be cut, if certain programs need to be cut or made smaller. So Democrats are still seem to be pretty far away from coming to an agreement on that.
Always there is work to do. Emily Wilkins of Bloomberg Government, thank you so much. And today's jobs report from the U.S. will be key for investors to assess whether the abrupt decline in hiring in August was a blip or something with staying power. Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now with more. So, Mike, Jerome Powell said he just wants to see a decent report. Is there any indication that today's numbers won't be decent?
No, all the numbers that kind of lead up to this report, the ISM numbers and the ADP numbers, have come in fairly strong. So it looks like we are going to get a decent number today. And that changes the question a little bit for the Fed. Usually we're saying this will give us some clue as to what the Fed's going to do. In this case, it should only confirm what the market has already decided is going to happen, and that's a Fed tapering in November. You can see the numbers there. 500,000 jobs is the estimate. The whisper number on Wall Street is closer to 525. So there's a feeling that we're leaning towards a better than expected report, which would certainly confirm views on the street about the Fed. The unemployment rate expected to dip to 5.1%, could go lower than that if the participation rate doesn't go up as much. If more people are looking for jobs, then the unemployment rate might not fall as far.
Right. Mike, what clues can we get about this mysterious American economy from the wage data specifically?
It's getting hard. Well, it's been hard, Danny, to say because the mix of jobs matters a lot. If we get a big number in leisure and hospitality hiring, bars and restaurants, that's going to pull that number down a little bit because those are lower paid jobs and they'll skew the average. But if we don't, which is what happened in August, then you see a stronger number in terms of the outcome for the wages and salaries figure. So we're watching that closely. You can see the bars and restaurants hiring had flattened out. It was growing, but now we're waiting.
Mike, thanks so much. Our Michael McKee there, Bloomberg International Economics and Policy Correspondent. We are indeed waiting. Tesla moving its corporate headquarters to Austin, Texas, after making California its home for 18 years. Well, the chief executive officer, Elon Musk, announced the move at the Austin plant on Thursday during the electric vehicle makers' shareholder meeting.
We will be continuing to expand our activities in California. So this is not a matter of sort of Tesla leaving California. As I said, our intention is to actually increase output from Fremont and from Giga Nevada by 50%. So, but we're just hitting the sides of the bowl.
Let's go straight to Craig Trudell, who leads Bloomberg's autos coverage. Craig, I mean, this was quite an announcement. First of all, he says we're changing headquarters, and then, of course, chip and chip shortages will hurt them.
Yeah, the headquarters move, I think we saw that coming a little bit with the fact that the last couple of press releases, they datelined them from Austin, which everybody sort of noticed and sort of, guessed that maybe that this was coming. I think the other thing to keep in mind, it was totally avoided and sort of left unsaid. But last year, there was this really pitched battle between Musk over the California plant and how quickly they could restart it after the initial COVID shutdowns. And that really got heated. There were some politicians in California who had some sort of choice language for Musk, and he replied back, message received. So, we didn't revisit any of that drama, but that certainly came into play here.
All right, Bloomberg's Craig Trudell, thank you so much. Everyone seems to be making the move to either Texas or Florida. Now let's take a look at some stocks moving in pre-market trading here in the U.S. And one massive mover to the downside is Allocation. This is after regulators halted a trial of a study of its cell therapy. That stock is plunging 35% in early hours. Another stock moving to the downside is Rocket Lab. Remember, it rose 10% yesterday on news it won a contract from NASA, but maybe some profit taking this morning because the stock is down about 7% before the bell. One mover to the upside, though, is Momentive Global, which owns SurveyMonkey. This is on reports that it is potentially looking at a sale after receiving some takeover interest. So that is leading the shares higher to the tune of about 11% before the bell, Francine.
Kailey, thanks so much. We'll have plenty more, of course, on those stocks. Also coming up next, an exclusive conversation with the Irish Finance Minister. He's Paschal Donohoe, a conversation on inflation, but also global taxes. This is Bloomberg.
I don't think that the current American situation could be a hurdle in the way to a compromise and a final agreement on all the technical parameters of this new international taxation system.
A lot of work has been done. We're very close. Conversations are continuing. As I stand here today, I'm quietly optimistic that in time for the G20 Leaders Summit, we will be able to finalize an agreement.
I share the quiet optimism. This is a once-in-a-generation opportunity. It's a once-in-a-generation opportunity to make the international tax system fair.
Well, various leaders there on the global tax deal on Thursday night. One of the biggest hurdles was removed as Ireland agreed to sign up to a global minimum corporation tax rate of 15%. Now that makes an agreement at today's OECD meeting in Paris more likely. Well, we are delighted to be joined for an exclusive conversation by Paschal Donohoe. He is the Irish Finance Minister. Minister, thank you so much for coming on today. Now, if you look at what Ireland has been doing over the last couple of decades, it was really to try and fight to keep that tax rate at 12.5%. Why give up the fight today?
So it's about recognizing that the world has changed and that in this changed world, one of the reasons for that change is the growth of companies, how big many of them have become, and the need to ensure that our ability to collect tax is efficient and fair. You're correct to say, Francine, that the 12.5% rate has been a very important element of our competitive model in recent decades and in recent years. But there are many other things that make Ireland competitive, and I believe being in this agreement will still maintain stability in our tax offering, will still be highly competitive, and ultimately Ireland wants to be part of a once-in-a-generation opportunity and a once-in-a-generation change.
But, Minister, how confident are you that 15% will be the top level? Can you actually reassure U.S. companies in Ireland right now that it won't go up to 17 or 20%?
So one of the reasons why Ireland was not in the agreement earlier on in the year is because we did not have certainty in relation to that very important question. And the agreement as drafted, which I believe will be maintained in the OECD and beyond, is now for 15% as opposed to at least 15%. Earlier on in the year, I did believe there was the possibility that that figure could go up. That is the reason why Ireland could not enter the agreement then, but now it is 15%. I was making the case for that kind of clarity, that kind of certainty. It's now there, and it's one of the key reasons why Ireland has decided to join the agreement, and I hope this agreement is successful.
Minister, it's Kailey in New York. It's been estimated that these changes will cost Ireland €2 billion in corporate tax revenue. How do you fill that hole?
So the €2 billion figure is a figure that the Government of Ireland has developed over recent years. We have been including that €2 billion loss now in our budget planning over the last two budgets. I always believed it would be very likely that we would get to a point of global change, and in that global change, it would have an impact on our tax revenues. So we've actually been budgeting for this moment now since 2019. We are ready for it. And even though that does mean a loss of revenue for Ireland, I believe overall it is still the right thing for Ireland in the long run to be inside this agreement. It does give us stability for this agreement in relation to our rate, what our rate will be. We will continue to be competitive. But overall, a global agreement, if implemented, does bring stability. It does bring a kind of robust architecture to how we tax larger companies in the future. And that also is in the interests of Ireland.
Well, Ireland has been an important country at play here, but it is not the only country involved in this. How confident are you that a deal can be finalized this month?
This is an extraordinarily complex negotiation with so many countries involved in it. I hope and I believe Ireland entering into the agreement at this point gives the process further momentum at a very, very critical juncture. And I do believe we will get to a point, both today and then at the G20, in which we will see the vast majority, if not all countries, in the agreement. The alternative to this happening is that we see the growth of unilateral tax measures, we see the slow erosion of our global tax architecture. All of those things would bring additional risks, additional instability, which is why I believe the passage of an agreement is in our long-term interests.
Minister, let's get specific here, though, especially when it comes to the U.S. How confident are you that this agreement will pass the U.S. Congress?
Well, with respect, I don't think it's too appropriate for me to comment on what may or may not happen in America. You know, President Biden, Secretary Yellen are making the case very effectively and very strongly for changes that they want to see happen. It will be critical for all countries to be able to see that all countries are moving together. I do believe overall this agreement will happen. I believe all countries being in it, or the vast majority of countries being in it, helps all of us collectively in making the case for this reform. And I believe America will be a leader in making that happen.
All right, Minister, I think, and we'll see exactly how the day develops and whether we do have an agreement or not. I need to ask you about Brexit. Of course, I need to ask you about Brexit. How optimistic are you that a deal can actually be reached on Northern Ireland?
Well, we have an agreement in relation to Northern Ireland. We have an agreement in relation to the Northern Ireland Protocol, which was agreed by the British government, agreed by the European Union. Of course, all your viewers will be aware of all of the challenges in relation to the implementation of it. But I'm absolutely certain that the European Union is doing all it can to lead to a fair and pragmatic implementation of the protocol. And we have put forward so many ideas and options inside the protocol regarding how important issues can be resolved. We are playing our bit. We're stepping up to the challenge. I hope and I believe our friends in the United Kingdom will continue to be able to do the same. But an agreement was reached. The agreement at that point when the agreement was reached, was heralded and recognised as a really important moment for all. It was signed by all who were involved in the agreement, and I hope we can see its implementation.
So does the current chaos in the UK show that Brexit was a mistake?
Well, look, it was a decision that was made by the British people in a referendum. I always believed there would be consequences to that particular decision, but I equally always recognised the right of any country, particularly in a referendum, to make a decision regarding its future and its relationship with the European Union. That is, Prime Minister Johnson, his team are dealing with all of that, and they continue to make the case for Brexit. I'll continue to make the case for Ireland in being emphatic that the best way in which we can realise our social, our political, our economic freedoms is inside the European Union. And I believe the European Union as a political construct is invaluable for helping us rise to the challenges and opportunities of today and tomorrow.
So, Minister, what have you learned actually because of the energy crisis, and how do you plan to support, I guess, the citizens better through this energy transition?
And, what we have done in recent budgets is ring-fence the taxes that are associated with higher levels of carbon taxation and reinvest that back into how we can support citizens who would be in a vulnerable situation with rising living standards, and also support employers in dealing with the challenges that have begun to intensify in recent weeks and months. So we will continue our efforts with regard to that next Tuesday. I also have the privilege of working with all finance ministers within the euro area. We discussed this issue in Luxembourg last Monday, and in a meeting of prime ministers that will be taking place in the coming weeks, we'll be looking at how we can coordinate our efforts within Europe to do more together on this challenge. But I'm equally very clear that our transition to a lower carbon future, use of more renewable technologies and fuels, that work has to accelerate.
Minister, I know you're almost out of time, but actually maybe one final question going back to this tax deal. How worried are you that actually countries will push you because you've effectively stopped that red line? Is 15% the red line for Ireland going forward, full stop? And what do you say to countries that will try and push you further?
What I would say is we have an agreement which, if implemented, is a once-in-a-lifetime opportunity to bring stability to these issues. Everybody has compromised. Ireland has made a really significant decision, so we can be part of a solution that I think can make huge progress. My energy, and I believe the efforts and energy of many to come in the coming years, has now to be about how we can implement this agreement and make it happen all over the world.
Minister, thank you so much, as always, for your time. The Irish Finance Minister there, Paschal Donohoe, after a very important, of course, announcement from Ireland late last night saying that they will abandon its 12.5% tax as this global deal is racing to a finish, and we could have an agreement as soon as today.
We could.
And I do think, sorry, go ahead, Kailey.
The question is, and Danny asked it, whether or not the U.S. Congress will then ratify it. Janet Yellen may have her work cut out for her in terms of getting it approved here domestically, especially if we get a new Congress composition in 2022.
Yeah, and if it doesn't get ratified, then all bets are off. Coming up next, Andrew Sheets, Morgan Stanley Chief Cross-Asset Strategist. This is Bloomberg. Well, this is Bloomberg Surveillance, early edition. I'm Francine Lacqua with Danny Berger in London, Kailey Leinz in New York, Matt Miller off this week. Now, a lot of the focus, of course, Danny, is on the U.S. jobs report. If you look at markets, they're kind of trading sideways before we get that jobs number that could give us an indication of whether the Fed can continue tapering or not.
Yeah, and Jay Powell, even though, said himself that he doesn't need an extraordinary jobs number to really get them to move. And in light of that, I'm going to insert my newly British bias because I am very British now, as both of you know. And I think the most fascinating story right now is what's happening in the UK bond market in gilts. We've really seen the yield just take off because of the energy story. And that, in turn, I think is bullying U.S. yields up a little bit more than they would be otherwise. I know it's usually sort of a bond market on the periphery, but Fran, I think it's so fascinating right now.
Yeah, it's fascinating. And actually, there's a repricing overall in fixed income like 4 weeks ago when Andrew Bailey said inflation could be much higher than expected. So, UK dynamics, but overall, it does seem that the Bank of England could actually change yields across the world. Who would have thought? Kailey, what are you seeing in the markets?
Yeah, it's an excellent point, Francine. I mean, right now, the 10-year Treasury yield is almost 30 basis points higher than it was back on September 22nd before that Fed and BOE decision. Now, when it comes to the equity market in Europe, stocks are right around session lows. Right now, the stock 600 is down about 0.4%. And here in the U.S., after 3 days of gains on the S&P 500, right now, futures are in negative territory. We're down about 0.2% on S&P E-minis. In the bond market, as Danny was alluding to, we are seeing yields continue to creep higher. We're up 2 basis points on the 10-year right now. 159.25 is where we sit. That is the highest level since June, and getting close to that 160 level that could create some convexity hedging and make yields be pushed even higher. And then, of course, we have to keep an eye on oil as well. 7th consecutive weekly gain WTI is heading for. Right now, it's trading at $79.10 a barrel, which is the highest going back to 2014. No surprise with that move in oil. Energy stocks are outperforming in pre-market trading. The likes of Devon and Occidental each higher by about 1.5%. And then you also have Bitcoin gaining today. It's back above $55,000 at its highest level since May. And so some crypto-related equities also getting a lift in early hours. Bit Digital, Riot Blockchain up 4% and 2.6% respectively, Danny.
All right, Kailey, I want to talk about earnings because we have guests come on here all the time and say they're optimistic because of the earnings picture. I also want to welcome our radio listeners as well. I have a chart which I will explain for you. And this chart is of the Citi Global Earnings Revision Index. When this is moving higher, I have a histogram here in front of me, again, for our radio listeners. When this is moving higher, it means that analysts are upgrading their earnings expectations. When it flips into the red, that means they are downgrading. Now, for most of the past year, especially given base effects from the pandemic last year, it has been in the green. Again, for a radio listening audience, what we've seen recently, however, is those green bars start to diminish. Now the direction of travel is downwards. In other words, the rate of upgrades is starting to fall. And it really just adds to this very uncertain environment. We don't know exactly what Q4 is going to look like. You have energy crisis, you have shipping issues, you have inflation. So with all of this, where do you want to be positioned? Well, our next guest, if I can use a phrase, but kind of change it up a little bit from how we usually say it, cash is perhaps not trash. That is Andrew Sheets, Chief Cross-Asset Strategist at Morgan Stanley. So, Andrew, a move into cash over there at Morgan Stanley, what's the thinking behind that?
Yeah, great. Thanks a lot, Danny. So look, let's be clear. Cash is a very poor long-term investment. It should be a very small part of any sort of long-term portfolio. But I think there are really kind of two things that we're focused on when we moved overweight cash in early September. The first is over much shorter periods of time, cash can outperform, even if it's very low yielding. And we have quite kind of cautious views across both the U.S. equity market and the U.S. bond market. So I think having a higher than normal position in cash is very consistent with both our forecasts and, a number of near-term issues that the market is trying to navigate. But the other issue is that, when we think about, you always hear about cash on the sidelines, these big cash holdings, we need to think about that relative to what I'd call wealth on the field. The amount of money people already have invested in the market, which is near an all-time high. And so those high cash balances don't reflect as much caution as I think people might otherwise assume.
Andrew, give me a sense of what you're expecting from the U.S. jobs report today. Even if we get a lousy U.S. jobs report, is the Fed itching to taper but make a difference between tapering and hiking rates?
Yeah, so I think this is an incredibly important jobs number. I think this one and the next one are very important, right? All these kind of various excuses the market could point to, the summer, the schools not being open, various kind of extra unemployment benefits, those have all gone away. Those are all normalizing. So we're now getting, I think, a much cleaner picture of the true state of the economy. At Morgan Stanley, we're above consensus today. We're at 700,000 on the estimate versus kind of a 500,000 consensus. We think the participation rate will go up. So we think it will be a relatively constructive number. That said, I think the Fed has shifted towards a more hawkish stance. So I think the bar to get them off of that is going to still be somewhat more challenging, but we are expecting a good number today.
How much of that is that priced in? And if you look at some of the energy crisis, are we underestimating the impact this has on companies and on earnings going forward?
Yeah, so we still think there's more room for the rate market to price higher. Our interest rate strategy team is still calling for higher bond yields. We think that will push the U.S. 10-year towards 180 by year end. We also still think that you can see rates go up more in the front end of the curve, something like a 2024 December euro dollar. We can still see more movement there, the market to price in a faster pace of rate hikes. And I think on energy, we think the margin picture is pretty important. We think earnings revisions are at risk of turning down in the U.S. That's one reason my colleague Michael Wilson is more cautious than the consensus. And we do think this is a very important earnings season. We think the consumer discretionary sector is probably the most exposed to some of those factors. A sector like financials, where obviously there's not much energy input into the earnings mix, is a sector we think can do better.
Well, Andrew, when you talk to those who are more bullish than maybe the team at Morgan Stanley and ask them why they are so bullish on the equity market, the answer is pretty much always earnings. If earnings do not surprise to the upside or don't meet lofty expectations, what is left to support equities?
Yeah, Kailey, so that's a great point, right? As much as we talk about central bank policy and liquidity, I mean, year to date, the S&P 500 is up about as much as the earnings estimates have risen. So the market's risen kind of in lockstep with earnings. There's been a really strong fundamental driver kind of for that rise, or a strong fundamental link, as much as I think we all kind of like to focus on other factors. And so that cuts both ways. If that earnings picture is no longer strong or starts to fade, then I think that does take away one quite important element. And I think companies are also getting squeezed in a somewhat unusual way, right? Both from the energy side, from the commodity price side, from the labor side. But the other thing that's important here is I think this dynamic is really uneven across sectors, right? When we think about the intensity of commodities, how much pricing power different companies have, how labor intensive they are, these are characteristics that differ enormously across the corporate space. And so I think it's more like a 2005 type of scenario, maybe, where overall growth is good, inflation is picking up, but you see a lot more intra kind of market and intra-sector dispersion based on those different factors.
So, Andrew, based on everything you just said, if I don't want to go to cash, I want to stay invested, how do I protect myself?
So I think there are kind of a couple of areas to focus on. We are constructive on the energy complex, especially longer dated oil. We think is really doesn't price in a continuation of these squeezes, so can offer kind of a good hedge against a scenario where these disruptions continue. It carries quite well. It's very boring, but we think European credit is somewhat insulated from some of these other factors that are going on at the moment, given it has extremely strong technical support. So those are two areas that we think can outperform on a relative basis.
Andrew, thanks so much. As always, Andrew Sheets, their Chief Cross-Asset Strategist at Morgan Stanley. Now, coming up, we talk a lot more about the U.S. jobs report with Jay Bryson. He's Wells Fargo Chief Economist. We'll talk about labor participation and inflationary wage pressure. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Willett Advisors Chairman and CEO Steve Ratner. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Francine Lacqua and Danny Berger in London. Well, it's Jobs Day, and today's report will be the last one before Fed members convene in November to make a widely expected decision to begin the tapering process. Joining us now is Jay Bryson, Chief Economist at Wells Fargo. Jay, what is the lowest possible headline number where the Fed can still proceed with a November taper?
Well, you know, if you get something in the order of where we got last month, 235, I think it's going to make it difficult for them to go ahead and do that. You know, I don't know what the exact number is. 300, I think, would still be a disappointing sort of number. If you start to get up to 400, then maybe enough of the FOMC members think it's time to go. But, you know, again, if you get something like you had last month, you know, I think that makes it really difficult.
Yeah, well, Powell has said he wants to see a decent report. So whatever the definition of decent is, I guess we will find out. I want to ask you about participation, though, because we got NFIB data yesterday that showed 51% of small businesses had roles they couldn't fill in September. What is behind the persistently lower participation in this labor market?
Well, there's a number of factors. Okay, start with COVID, for example. Okay, so, you know, we have a lot of people who need childcare, and childcare facilities right now are hurting. Schools were closed up until, or largely closed up until this point. So those people kind of need to stay home. You know, another thing with COVID is maybe you're just afraid to go into work. With a lot of people potentially could be affected. And then there's a longer term sort of issue here. And if you look at participation among people who are 55 to 64, a lot of that participation after when COVID set in dropped. It hasn't come back at all. A lot of those folks probably aren't coming back. Maybe they're retired at this point.
Jay, can you talk to me a little bit about the psychology right now of central banks and especially of the Fed? Are they worried about inflation more than they let on? They keep on saying it's transitory, but if you look at the latest energy crisis, it's difficult to see how transitory those price hikes can actually be.
You know, I think they are a little bit worried. You know, for instance, you know, president of the St. Louis Fed, Bullard, recently came out and said that he thought that the risks were skewed to the upside in terms of inflation. Now, he doesn't necessarily speak for the entire FOMC, but I think that's a telling sort of indication. I think inflation has surprised them to the upside here, surprised, you know, many folks, quite frankly. And when you look at things that can be persistent, like owner's equivalent rent, housing, yeah, that can continue to feed into the system for a while. So I think there is a little bit of angst on the FOMC right now about what the inflation outlook actually holds.
Jay, do you worry about inflation? Do you think it's transitory, or do you think we're looking at a massive policy mistake for banks?
I think it's, you know, our view is it's largely transitory. I mean, you know, there's a lot of supply constraints right now caused by COVID. There was some extremely strong demand because of stimulus checks, things of those nature. As you go forward, those two things should start to reverse somewhat. That said, I don't think we're going smoothly back to 2%. You know, our view is next year the inflation rate is going to be higher than what the Fed thinks. We think that, you know, it's going to be north of 3% throughout much of the year next year. And so we'll set up an interesting dynamic, I think, for the Fed as we get into next year about whether they start to tighten policy or not because of higher than expected inflation.
But if that higher than expected inflation, Jay, is being driven by the supply side, are central banks and the Fed hamstrung in their ability to really get prices under control?
Well, they are somewhat, right? You know, if you can't get chips, semiconductor chips, and other sorts of crucial inputs like that, there's only so much the Fed can do, or they're very limited there. I mean, what they can do in order, say, you said inflation getting out of control, what's important here is inflation expectations. And so far, they haven't really spiked up here in the United States, particularly when you look at the, you know, long-term inflation expectations. If that starts to become unmoored at all, those things start to move up to 3% and higher, then the Fed does kind of need to get going with some stronger sort of signals about potentially. But they are somewhat limited at this point in what they can actually do.
Well, Jay, to bring that back around to jobs today, what are you expecting when it comes to wages and the potential for higher inflation to really eat into that inflation adjusted wage number?
So if we're looking at today, we're looking for annual average earnings to be up 0.4%, which is, you know, a relatively strong sort of number. Not like what we saw earlier this year, but it is still relatively sort of strong. I think the key in terms of wage inflation and price inflation kind of going forward is, and when we saw this back in the 1970s, right? What you had back then is a lot of folks had wages that were indexed automatically to inflation. So the price shocks hit, it pushed inflation up, wages went up, which then fed back into prices, et cetera, et cetera. Today, you don't have that. Very, very few people have wages that are automatically indexed. So this can be a kind of one-off sort of wage adjustment sort of increase. But as long as it doesn't continue to spiral upward, as long as it doesn't continue to accelerate, that brings down inflationary pressures going forward. The key, again, and I mentioned it earlier, is inflation expectations. If people really believe that inflation is going to be higher on an ongoing basis, they're going to want to continue to get bigger and bigger wage increases, and then you have your inflation problem.
Well, and if they don't get those wage increases, what does that mean for consumption and for companies' ability to pass on price increases to consumers?
Well, in terms of what it means for consumption, what we have seen is, if you look at the household balance sheets right now, they're very strong. The savings rate came up after COVID because you got all these stimulus checks, you had no place to spend it. So when you look at household balance sheets, people do have a pretty good cushion of spending that can kind of get them through, or cash that can get them through, the next next year or so, something like that. So I don't really worry about it too much from a consumption side of things. And the ability for businesses to pass on price increases, I mean, we'll see going forward. But if consumption growth decelerates, I'm not talking about going into negative territory. If it starts to decelerate and slow, the ability for businesses to pass on some of those price increases will start to become a little bit more tenuous, and they won't be able to do it. But right now, there's a lot of pricing power out there. I think the key is, where are we a year from now?
Wonderful. Thank you so much for all of the insight. Jay Bryson there, Chief Economist at Wells Fargo. And then a little bit later, we also discuss the jobs report with the U.S. Labor Secretary, Marty Walsh. That's in John Farrow's hour, 10 a.m. in New York, 3 p.m. in London. And this is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, Kailey Leinz in New York. We're also joined by Tom Keene, co-anchor of Bloomberg Surveillance. Tom, can you even contain your excitement? It's Jobs Day Friday.
It's Jobs Day, and it's a different Jobs Day. The last time around, the time before that, I believe it was 3 months ago, Francine, was that giant shock of everybody in the known world being wrong, wrong, wrong. Who knows what we'll see at 8:30 this morning. What I know, Francine, is it's a story of two Americas. This is a really cool chart. Thank you, Sri Kumar, the great, great economist, Sri Kumar, for this ratio. I usually don't show ratios on TV. They don't work, but we got to go here. This is a comparison of a lesser employed, all unemployed America as compared to the regular unemployment rate. And the green line is the normality before the financial crisis. And up we go to either more people unemployed, or is it a fully employed America? And the green line up top really indicates how fully employed we were before the pandemic, and where we are now is back to normal. It'll be interesting to see in the coming months how fully employed part of America gets.
Well, Tom, do we have to redefine fully employed for a post-pandemic world?
Listen to you. There are acres of economists at the University of Virginia studying this question, Kailey. And I can assure you this is a raging debate in economics. How do you define fully employed? How do you define unemployed? And the answer is there's three levels. Chairman Greenspan always liked the middle one called the augmented unemployment rate. You don't hear about that much anymore. There's 8 ways to slice this. That's the answer.
Tom, I know jobs is the event of the day, but I really have just continued to have my focus on oil. At one point, we were nearing $80 a barrel for WTI. I just want to know when Francesco Blanche is going to be back on your show doing a victory lap of $100 a barrel.
We're not there yet. I will tell you this, and I learned this years ago from a handsome gentleman in St. Louis. Oil's the toughest thing to predict, and oil is just brutal to forecast and pick. And yes, there's people out there looking for $100 a barrel. John Farrow and I are looking at the vector, just the inertial force, and every day it creeps up. We're not through to a high. 82.55. We're right there where we go to 83 a barrel.
A handsome gentleman from St. Louis. Tom, no one's more handsome than our very own Tom Keene, co-anchor there at Bloomberg Surveillance. I'm really looking forward to the show. And then, of course, speaking to the Secretary of Labor of the U.S. Now, look at what else we're watching. And Kailey, ta-da, a surprise. You're watching Jobs.
I know, shocking to everyone. I know. 8:30 a.m. Eastern time is when we get the print. Will it be decent is the question, because the reason why the September jobs report matters is it's the last one we're going to get before the Fed makes a decision on whether or not it's going to announce a taper in November. Now, I looked up the definition of decent for everyone, of an acceptable standard or satisfactory. So we will see if 500,000 jobs added to the U.S. economy in the month of September, which is what economists are expecting, meets that definition for the Fed. But of course, it's not just going to be about that headline number, Danny. We're also going to have to look at wages for the inflationary force that they may have, as well as the participation rate, because September was supposed to be the month that everyone came back to this labor force. The question is whether or not that actually happened.
Yeah, September is a weird one, too, because usually it's the end of that added hospitality for the summer holiday period. So definitely a lot of factors there. Well, I am watching, and fittingly, because we're just talking with Irish Finance Minister Paschal Donohoe earlier in the hour, these OECD talks around the tax rate. We really had a fantastic conversation with the minister, who really laid out that their vision of Ireland is that the world has changed, and they want to join this once-in-a-generation change. Of course, also saying that the alternative here is really just more unilateral tax measures. So a lot at stake, but the view right now is whether we will get that 15% floor, which at the moment Ireland appears to have agreed to.
Yeah, so I'm watching both of those things, but I'm actually working a little bit later on as well, because I'm moderating a pretty cool panel for the B20, G20, ahead of course, the Italian leaders meeting with leaders of the G20 in about 10 days. So we have Christine Lagarde and Janet Yellen. So this will be a conversation on monetary policy, on fiscal levers. And then separately, we'll also be speaking to Jeff Bezos with John Elkann of Exor. The focus there will, of course, be on some of the advocacy things that we've seen coming out of the U.S. I don't know whether it's a conversation on tax. Maybe we'll sneak it in, but certainly it'll be a pretty comprehensive summit that will take a lot of our afternoon. More Bloomberg Surveillance coming up ahead. We'll hear from Randy Krosner, University of Chicago, Booth School Professor of Economics, and Ellen Zentner of Morgan Stanley. This is Bloomberg.